The price changes in accordance with the trend, and this is an essential premise of technical analysis. When looking at the chart, the first and most important detail to identify is the phase currently going on. 3 market phases and the trend cycle concepts within the Dow theory can help traders understand how bull and bear markets are created. A. The accumulation phase. It starts when experienced traders enter their positions. During this phase, the price movements are slow and often fall into the end of a downtrend, with ordinary investors thinking that the bearish moment will continue. For the smart money, however, this is a good opportunity to enter the market because the prices are low. But how to recognize the accumulation phase is not always easy. Traders should look for extended periods of consolidations, when the downtrend starts to flatten out along with the selling pressure. During the accumulation phase, the price moves mostly sideways in a range. Because it comes at the end of a downward move, the accumulation phase could be perceived as a part of a primary downward trend. Market pessimism is still present with many investors and traders, thinking that everything will just get worse. Traders should also pay attention to broken consolidation channels that indicate breakouts, such as inverse head and shoulder patterns, and other bullish reversal patterns like cup and handle pattern. B. The public participation. Once the new trend is starting to become visible, the public participation phase begins. Traders join and drive prices higher. The longer the trend lasts, the more investors will enter a market. Market optimism becomes prominent, and the good news attracts even more participants. This phase tends to be the longest in duration and has the largest price movement. At the end of it, you will often see an excess phase where the trend accelerates even further. During the excess period, euphoria and irrational optimism are present, leading to a bubble-like extreme behavior. Led by greed and for fear of missing the opportunity, the last of the buyers enter the market with no awareness of the close and possible end. Experienced players start to close their positions, knowing that such markets are fragile and volatile. In this phase, there are signs of a significant downward pressure, increasing volatility, deeper pullbacks, and the loss of the upward trend wave power. C. The distribution phase. This is the initial phase of a bear market, opposite to the accumulation phase. At this stage, the market tends to be overbought, although the less experienced traders can still believe that more bullish movements could happen. Also, mistaking a current consolidation during a bull market for a distribution phase can be costly. The trader should look for patterns in the distribution phase, like the bearish reversal patterns. And in the markdown phase, which follows distribution, he or she should look for bearish continuation patterns. So the phases exist in the context of an uptrend or in the context of a downtrend. This kind of trading based on the trend is a really common trading strategy, where apart from trading lines and chart patterns, traders also use moving averages and momentum to identify the current market trend. What is important to learn here is that a phenomenon exists in a context. That means that when you have identified the current phase as well as the phases that have already happened, then you identify patterns inside the phases because they exist in the context of the phase. For example, if we are talking about the accumulation phase, you can look for a bullish reversal pattern, let's say for the double bottom pattern. The indicators are only valuable if they exist in the context. On their own, they are just pieces of information. It's not about which indicators you use or how many you use. It's about seeing the big picture, the larger context. To further understand psychology behind trading, let's examine 2 major things happening regarding all the movements on the market: tension creating and tension releasing. Let's take an ascending triangle pattern as an example. An ascending triangle pattern has 2 key elements. Number 1, bottom trend line or support. Number 2, flat resistance line. The more touch points there are on the support and resistance lines, the more reliable the pattern is. An ascending triangle is generally considered to be bullish and a continuation pattern, of course, if it exists in a context of an uptrend. Ascending triangles can be used on multiple time frames. They may exist on hourly charts, daily charts, and weekly charts. When we say that a crucial thing to do is to look at the pattern or indicator in the given context, that also refers to a time frame context. This pattern can be represented by the ongoing battle between the bulls and the bears. The bulls keep pushing the price up until they get overpowered by the bears, and the resistance line is formed. The bears then attempt to push the price down. However, the bulls are persistent and the bottom trend line is formed. The battle of the bulls and bears creates tension, and the visual representation of the triangle shows how the energy that drives the up and down price movements is becoming more and more nervous, just begging for the breakout. Tension releasing can go either way, up or down. But historically speaking, like we said, ascending triangle pattern usually exists in a bullish context, and if the flat resistance line is broken, the bulls will be able to push the price up, and that tension will be released, like magma from a volcano.